Hi everyone, and thank you for joining our webinar today, where we will be discussing the topic of maximising hedge fund returns in a time of COVID-19. My name is Amy Benstead. I am Head of Preqin Pro here at Preqin, and also one of our hedge fund specialists. I'll be moderating a panel session later in the webinar to discuss how COVID-19 is impacting the hedge fund industry. In that panel, we will first look at how investors have changed portfolios in light of the pandemic, and how investors source and diligence fund managers during lockdown, and whether these changes are here to stay. Joining me on the panel later are three very distinguished panelists. We have Tom Kehoe from AIMA, Mick Swift from Abbey Capital, and last but not least, Remco van der Earth from Kempen. Before I hand you over to our first speaker, I will run through a couple of housekeeping notes. First, we'll send all registrants and attendees an email later today containing a link to access the webinar slides and recording. Secondly, if you have a question, please use the Q&A icon at the bottom of your screen as opposed to the chat icon. So please do remember Q&A. We will do our best to answer as many of your questions as we can during the webinar. So without further ado, I'd like to hand you over to our first speaker, my colleague Sam Mackenzie, who is presenting some Preqin data to show how the hedge fund sector is navigating the current situation. So over to you, Sam.
Excellent, thanks very much, Amy. Hi everyone, I'm Sam Mackenzie and I'm the Research Manager for EMEA Hedge Fund Data at Preqin. Thanks again for joining us for today's hedge fund webinar. As we're all very well aware, COVID-19 has had a dramatic impact across the entire world, affecting not just financial markets, but the wider global economy, and of course our everyday lives too. Today we're going to focus on the hedge fund industry and how it's been affected by the COVID-19 crisis in recent months. We'll look at some hedge fund performance data to see how well funds have navigated the market turmoil. We'll also explore how investors are reacting and how their plans for 2020 have actually changed. After that, Amy and the expert panel will take a deeper dive into some of the main questions and themes within the industry today. Let's start by taking a look at some recent performance within the hedge fund industry. Along with almost every other type of investable asset, hedge funds fell in 2018 due to vicious stock market volatility in the final quarter. On the other hand, 2019 was a more successful year for most hedge funds, as rising markets buoyed performance. In fact, the Preqin All Strategies hedge fund benchmark rose 11.1%. Heading into 2020, performance almost immediately fell as the first few cases of COVID-19 were reported in Asia and the virus began to spread across the world. The drawdown was frighteningly quick compared to previous market events. In February, the benchmark fell by 2.34%. The biggest monthly drop since the volatility at the tail end of 2018. Then in March, the benchmark posted its worst month on record, falling 9.13%, worse than any month in the GFC or the dot-com crash. Following these losses, the benchmark recovered somewhat in April and May, but the average hedge fund is still down 3% year to date. Despite the dramatic drop in March, hedge funds proved their worth during the first quarter when compared to most major equity indices. For example, the S&P 500 fell by around 20%, almost twice that of the average hedge fund. Low beta strategies such as macro and relative value funds, as well as CTAs, have protected capital and are in positive territory for the year so far. Unsurprisingly, strategies with higher market exposure have fared less well, with equity and event-driven funds the worst hit during March. When looking at year-to-date performance broken down by region, funds focused on developed markets have outperformed those focused in Asia Pacific and other emerging markets such as Latin America. North America focused funds in particular are down 2% year to date, while European focused funds are lagging slightly behind, down around 3.8%. And we also see differences between funds focused on specific regions in how quickly they've regained ground lost in Q1. In March, North America focused funds were in a 12% drawdown, deeper than both funds focused on Europe and Asia Pacific. But by the end of May, North America focused funds had quickly climbed back, outperforming European focused funds by around 4.3 percentage points during April and May. Analysing the distribution of hedge fund returns shows a clear positive skew. Most funds have sustained losses so far this year, with around a third of all funds falling by more than 10%. But on the other hand, 30% of hedge funds have posted positive returns, which speaks not only to the diverse range of outcomes within the industry, but to the ability of some managers to deliver significant alpha in such a turbulent environment. While they can be difficult to find, it's clear that some funds have provided excellent diversification to investors' portfolios this year. If the rest of the year is as chaotic as the first half has been, what can we expect from hedge funds in terms of performance? It might be useful to look at how hedge funds performed during the last major crisis. So let's wind the clock back and see how hedge funds fared during the GFC. The worst period for hedge funds was in the second half of 2008, when the collapse of Lehman Brothers contributed to losses of 6.65% and 8.1% in September and October, respectively. But the overall benchmark's recovery was quick, beginning in December. Between December 2008 and April 2010, the benchmark experienced only one negative month in February 2009. Are hedge funds likely to bounce back as quickly and as convincingly in 2020 as they did 11 or 12 years ago? It is possible, but it's worth noting that the GFC was, of course, a financial crisis, whereas COVID-19 is a completely different animal. In short, it would be wrong to label this crisis another one of those, considering we're still in the early stages. The longer-term effects are ambiguous, and they have the potential to be very damaging. This is especially true when we compare the tools available to governments and central banks 11 or 12 years ago with what's possible today following years of QE and record low interest rates. It'll be interesting to hear what our expert panel have to say on this topic later on. Let's turn now and examine assets under management and asset flows. Since the start of 2018, investors have pulled a total of $180 billion from the industry on a net basis. But it should be noted that this still only represents around 5% of the average total industry AUM since that time. In the first quarter of this year, almost 50 billion flowed out of the industry, and yet this still only makes up around 1.4% of total industry assets, hardly a mass exodus out of hedge funds. The recent outflows mean that total industry assets now stand at $3.31 trillion, down from a record high of $3.66 trillion at the end of 2019. Let's move on and see how hedge fund investors have responded to the crisis. In the hundreds of conversations that Preqin analysts have held with investors around the world so far this year, many have shared that they plan to scale back their hedge fund investment plans over the next 12 months. In January, we were tracking 744 active hedge fund mandates, with expected top-end commitments worth $14.4 billion. These numbers have fallen in recent months, and we're now tracking 644 mandates, totaling $12.6 billion in commitments. This only represents those investors who have confirmed with us that they will definitely be investing additional capital over the next 12 months, and doesn't include those who are still considering their plans in light of the current situation. It seems like investors were spooked by the volatility in Q1, and subsequently, those with ideas to make large allocations to hedge funds are reassessing these plans. In the first quarter, of the investors we spoke with that had concrete plans for their hedge fund investments, 9% were looking to allocate $300 million or more over the coming 12 months. In the second quarter, there's been a noticeable pullback from investors, and those big ticket allocations have been trimmed down. At the smaller end of the spectrum, not much has changed since Q1, with the proportion of investors looking to make allocations of less than $100 million remaining fairly stable. In terms of strategies, we're seeing investors branch out and target a wider variety of funds compared to the first quarter. In Q2, investors are generally reporting more interest in strategies outside of just long-short equity, with a significant uptick in those seeking out suitable allocations to managers within the credit and fixed income space. During the quarter, we have heard from investors that some managers believe there are significant dislocations in the credit space, within distressed credit in particular, and they've been raising funds to take advantage of these opportunities. In 2019, Preqin tracked more fund liquidations than fund launches for the first time ever. Considering the events of the year so far, we do expect this trend to continue in 2020. We're already seeing a smaller number of reported launches than we would expect by this time of the year, and again, liquidations are outnumbering those launches. This will likely continue for the foreseeable future, as we receive more data on the funds that didn't survive the initial COVID-19 crash. We're now tracking a total of 16,800 unique hedge funds, a number which has grown by around 25% since 2012. So to summarise, the drawdown in hedge fund performance during Q1 was the quickest we've ever seen. Unsurprisingly, funds with greater market exposure, such as long-short equity and event-driven funds, experienced deeper losses than those with lower market exposure, such as CTAs or discretionary macro funds. For hedge funds, some progress has been made towards recovery, but there are still plenty of unknowns in the market, and we're yet to have a clear idea of how the medium to long-term effects of the COVID-19 crisis will play out. Although most funds suffered losses, around 1/3 ended the year in the black, with a small slice of those funds generating double-digit returns so far this year. While the average hedge fund is down around 3%, there are clearly some who have successfully navigated the volatility. Total hedge fund industry assets fell by around $344 billion in Q1, with around $48 billion of capital outflows. These outflows only represent about 1.4% of the total industry assets. With hedge funds likely to have dampened losses in investor portfolios during the first half of the year, it will be interesting to see whether assets continue to flow out of the industry, and if so, in what volume. According to our conversations with institutional and smaller private wealth investors, most are understandably cautious about the future, and many are scaling back their planned commitments this year. Still, appetite for hedge fund remains, and in particular, credit funds are being targeted by investors as they seek to take advantage of the price dislocations that have emerged from the market turmoil. With that said, that's everything from me. I hope you found that data informative. My details are on the final slide here, so feel free to send in any questions that you may have. Otherwise, I'll say thank you very much for listening, and I'll now pass you over to Amy and the expert panel. Thank you.
Thank you, Sam. That was really, really interesting and really insightful. And I think it's given us all a lot of food for thought for our panel session today. With three great panelists today that have a wealth of experience in the hedge fund sector, but like all of us are finding our feet in this new world of investing and working remotely during the biggest health crisis in the century. Before I ask the panelists to introduce themselves, I'd like to start our first audience poll. The polls are your opportunity to let us know how COVID-19 crisis is shaping your work and business today. The first poll question will be for investors only and should be appearing on your screen now. So for the investors, for the allocators out there, how have you changed your hedge fund portfolio in light of the pandemic? Has it had no change on your exposure? Have you redeemed up to 20% of your portfolio, redeemed more than 20% of your portfolio, or have you increased your exposure by up to 20%, or increased it up by more than 20%? I'll now ask the panelists to introduce themselves, and we'll come back to those results a bit later in the session today. So Tom, can I start with you, please? Can you give a brief intro to yourself, and then we'll move on to Mick and then Remco.
Yeah, sure, Amy. Nice to be speaking to you all today, and thank you very much to Preqin for the opportunity for joining today's webinar. My name is Tom Kehoe. I head up research and communications at AIMA, the Trade Association for Alternative Investments, so the global representative for hedge funds and private credit. I've been in the hedge fund industry now 16 plus years.
Hi everybody, my name is Mick Swift. I'm the CEO of Abbey Capital. We are a multi-manager allocator to the managed futures space based in Dublin and New York. And we've been in the business for about 20 years.
Good afternoon, my name is Remco van der Erf. I co-head the Alternative Strategies team at Kempen Capital Management. I've been in hedge funds since 2001 and with Kempen since 2008. And at Kempen, we manage both sort of commingled vehicles as well as customized separately managed accounts. And we have roughly 1.5 billion spread across 20 to 25 manager relationships.
Thanks, everybody. Before I start asking questions, let's have a look at the results of that poll, please. So quite interesting, actually. So largest proportion, no change, over half of all respondents on there. And in fact, a bit of a split by redeeming and increasing exposure. So perhaps weighting a bit more to the redemption side, which is chiming with some of the data that Sam showed around outflows. But again, chiming in with what Sam did mention is the outflows aren't as big as we might expect, and does show some indications that capital could be flowing into certain hedge fund strategies. So with that in mind, and I'll start with you, Remco. I think Sam touched upon a point about there's a lot of interest in credit strategies at the moment, which I imagine is music to your ears. But what did your portfolio look like coming into the crisis, and how have you rebalanced throughout it?
Sure. It was actually a very active time in March for our portfolios. We came into 2020 with a relatively defensive positioning. We had an all-time low allocation to long-short equity. We had a high allocation to macro and CTA strategies. We even had some dedicated long volatility exposure, and we were sort of shielding in insurance-linked securities as well. In the midst of March, we actually turned the portfolio relatively strongly by increasing risk. So what we did is that we reduced our long volatility exposure both mid-month and at the end of the month. We exited our CTA exposure altogether. We trimmed the macro managers where we felt there was less embedded value. And what we did is that we added exposure to structured credit, which we felt was the hardest hit strategy at the time. We added exposure to credit distress managers, basically hoping to participate in this default cycle. And we also added capital to merger arbitrage and to emerging markets related macro managers.
It's a pretty active time for you, a pretty busy start to the year. I mean, you mentioned that you cycled out of managed futures. I mean, Mick, maybe now's a good time to chime in because it's obviously an area of expertise for you guys. Did your portfolios change over the course of the first 6 months of this year?
Well, I suppose when we look at managed futures, we look at, we're a multi-manager provider, so we're looking at all the different trading styles from trend following to short-term to macro to value-driven styles. So again, I suppose we've been consistently looking for robustness across our styles, and coming into 2020, we were obviously coming in a very low volatility environment. Positions were, you know, the equity markets looked very well before we saw the sell-off. So we were coming from a very low volatility environment, and you know, many managers were effectively invested in markets. And what we saw then was the shakeout, which happened very quickly. What we found was in our own multi-manager portfolios, it was generally a good time for CTAs because we are, you know, fast responders to the short-term traders who capture that uptick in volatility very well. And that's exactly what you want in terms of robustness of multi-manager over time, that you respond to the markets as they happen. So generally speaking, what CTAs found in Q1 was that they responded well, and overall did quite well to capture the trends in energy, in fixed income as well. And overall did exactly what I would expect them to do. Now, we always will have high dispersion amongst CTA managers as well. They're not, you know, even in the trend following space, we've seen that, some strong outperformance and some underperformers as well. But generally speaking, what we found is our own dispersion amongst the trading styles, which is something we keep quite robust, worked very well. And then obviously we as Sam showed in his presentation, you know, managed futures did quite well in Q1, which is exactly what clients were looking for them to do in that environment, as we responded to the crisis.
So obviously, you know, things are changing very quickly, and performance, as you said, was quite dispersed, quite a wide dispersion between, you know, top performers and the worst performers. And obviously, communication and transparency of what's going on is key. I mean, with the managers that you work with, Mick, how have you found they've adapted and approached the crisis? And, you know, what's impressed you, and maybe what hasn't impressed you, and where do you think more change is needed?
I think one of the things about the managed future space, and generally speaking, is that managers tend to be very dynamic in terms of being very much responsive to the environment, because this in a way is what managed futures is used to. It doesn't necessarily predict what will happen. It responds to what happens, and the speed of response very much gives you an insight to that. So from a practical point of view, as a multi-manager allocator, all of our systems, operations, etc., all the underlying managers performed within our expectations. We did have a couple of environments when we had some short selling bans. It seems like a long time ago now, but we did. And obviously managers will look at the underlying markets there and decide whether that they participate. So what I would say, generally speaking, as I look across the sort of the ecosystem we work in, from our clearing brokers to our prime brokers to our administrators, everything worked very well. And you know, for us, we use the vehicle of a managed account. So that gives us full visibility and look through every day. So again, that's a hugely important part of us, that daily liquidity we give to our clients, and the managed account feeds into that. And we saw that all of those systems worked really well through that period, which I think is shows a great sign of robustness. And you know, when we were talking in our prep the other day, that sense of the difference between 2008 and now, and how the markets have responded is interesting. So overall, we found that the environment and the infrastructure worked incredibly well.
I mean, Tom, to that point, I mean, how do you think managers are equipped or were equipped coming into this crisis compared to the GFC, and what changes are you seeing with the fund managers, members of AIMA?
Well, to take your last question first in terms of communications and transparency, I think it's the difference really is, with all due respect to certain percentage of the industry back in 2008, the difference is really night and day. I will echo the comments of what Mick has said in terms of the conversations we've had with our own investor members, and been very active certainly throughout March and April in speaking to them. And their sense was they were getting, if anything, even too much transparency from their managers. And if anything, too much of a focus around how they were being able to manage their business continuity. Because, there were a lot of questions on that at the time, as you know. So I would say the advent of video conferencing rather, that has been critical to how communications has worked during this time. I wonder, even if we were 5 years ago, if this had happened, whether we would have been able to operate like we have done over the last couple of months. So certainly the engagement between investors and managers has been very positive. And to Mick's point as well, our sense is from speaking to the investors over the last couple of months, we think there'd be a big move towards managed accounts and more of these customized structures between the investor and the manager and away from the commingle. I don't think we'll be seeing the end of the commingle, but certainly this period has had investors think again about the need for having greater transparency and greater control over their portfolio and that engagement with the investors. So I would say, in terms of comparing it to 2008, very much different outcome. No sense of panic at all either between the investor community we spoke to or the managers. It was just, can they get through it, and how to navigate through that in the best possible way, providing full transparency around the situation to their investor clients.
So almost a bit careful what you wish for in terms of transparency, but it's a good thing. Zoom conferencing calls and lots of updates and information, and maybe a move to managed accounts, which we've been talking about, I think, for the best part of a decade since the last financial crisis, and it feels like this will be another impetus for it. I mean, Remco, on that topic, does that chime with your experience? Is there anything you've particularly seen managers doing well, or anything they could do better on?
Now, I would echo the point on transparency, which has been great throughout March and thereafter. I think managers have made themselves available. Accessibility of PMs has been great, and transparency has been super as well. And if I sort of wind back the clock and go back to 2008, at the time it was really hard work to find out what people were investing in and how their sort of performance contribution had come together. These days it's so easy, and then that game has completely changed, and I think it's much more of a partnership today than it was let's say 12 years ago, and that's an evolving element that I've enjoyed about this whole industry.
Mm-hmm. Yeah, I think that just the change in the hedge fund sector is immense over the last, since the financial crisis. And
yeah,
I have to remember that, which makes me feel very old now. It's 12 years ago almost. It's crazy, but it's do see fund managers really evolving. I think that is the strength for the hedge fund sector. It never stays still. It's a constant arms race and change.
So one example I would give there is that we had capital with a long volatility manager that was sort of up 70 points for the month. So obviously that was great when other strategies were losing money. And given the fact that they were up so much, they offered a mid-month trading date to investors, which most of the investors took up. And that is something that they came up with proactively. And if I sort of look back at 2008, that would never have been possible at that time.
I mean, Mick, as a manager of investors' assets, are these the same questions you're getting asked for your investors? It's transparency. Have these questions changed during the course of this year, and how have you adapted? It sounds like you're already using things like managed accounts to help with this full transparency. Do you think you're well equipped, or is there more changes you needed to make? Oh, you're on mute, Mick.
Sorry, we've always been a managed account that really defines the core of what we do as an investment advisor. But I think I think we were, and the industry, across the board it was well positioned for this type of transparency and understanding when the stress hits. It's very important to communicate. So I think, as both the guys have said, I think managers were quite proactive in terms of getting that out. Probably one of the difficult challenges is that, as an industry which is often based on personal relationships and, salespeople and relationship people in the field, that element of how COVID affects us is the sense of how you communicate, and to the virtual world. You saw a very big ramp up, and what we're doing here today is an example of that. Is that sense very important? But what we found generally from clients is that people were comfortable with their alternatives because a little bit, as Remco said there, that the managers were certainly proactive, and people understood the liquidity profile of what they had. And probably, if I remember back to 2008, there was a lot more angst around liquidity, and investors were getting caught up an awful lot with gates and etc. and all that. So I think the environment right now has been, how it's evolved over the years, as Tom says, has become much more dynamic and responsive. So I think people felt an element of comfort with their alternatives across the board, because equally at the time, there were bigger fires to worry about, even though it was very fast, etc. But there were bigger things to worry about. And we certainly found that about, both our managers communicating with us and then us communicating with our clients. It was very much important to be proactive, but also understand that people had other things they were watching as well.
Yeah, that's that I think that chimes a lot what we're hearing as well. Before we move on to fund manager selection, we've had an audience question come in, and it's for you, Remco. It's, why did you completely exit the CTA space? What was the driver behind that?
That's a good question. It basically did what it had to do because it performed a lot better than most other strategies in Q1, and it was liquid, so it offered us an opportunity to rotate into strategies that had a lot more embedded value at the time. So that is one point. The other point I would like to make is that with the involvement of central banks in capital markets, and with the sort of fits and starts of the economy and of the lockdowns in all the countries throughout the world, I think it will be hard for trend following strategies to sort of keep up and to be on the right side of the trade constantly. So we were basically using this as a funding currency. It had done its job in the portfolio, and I think so far that's been a very nice sort of rotation, because it has added to performance, and it didn't hurt us in Q1.
So you did what it needed to do, and then you changed tack. So
yeah, and it can also, I mean, if we sort of get closer to the end of the year, an allocation to CTAs might become in the cards again. Yeah.
Okay. Moving on to fund selection. So Mick, Remco, it sounds like you've been a fair amount of activity this year, maybe more, maybe less than usual, but obviously the processes of finding managers and selection is changing. You can't go into their offices, you can't go to a conference. How has that changed since we've been in lockdown, and what practically are you doing different than you weren't doing, say, a year ago? And Mick, maybe I'll start with you. Mick, you're on mute, I'm afraid. Sorry,
I'm trying to
50 times a day, I think. It's a new catchphrase.
We're definitely in a new environment, and I think, that's what happens, and we're all collectively in it. So the challenges for us all as allocators is maintaining the contact with our underlying managers first and foremost. I think structures like the managed accounts give us full visibility, so that's a great source of comfort to us in our investment strategy. Nonetheless, the effect on travel is something that we're all having to deal with. Virtual due diligences have become the norm from our client side anyway. And a lot of multiple more frequent contacts with managers is across the whole domain of their business, from operations right through to investment, is very much on the cards. And to some extent, as the guys mentioned, like that uncertainty is still with us. We're only 4 months into this, and that uncertainty remains. So the outlook is volatile, and I think that's where investors, what we notice now after the initial wave, is we're getting a lot more questions about investors in terms of, well, what the future may look like or not, and there's a lot of uncertainty out there. But yeah, I think from the manager point of view, what we found is We've added managers within this period. There have been managers where we had existing relationships, so we've done that. So we've done the virtual piece, and that's worked well. So that was always a big ask for any allocator, and will be, because in terms of how you do things before and how you do things now in a new normal. Conferences as well obviously have become more virtual. It does take away a little bit from the personal interaction, but if that's the new normal, we're all going to have to deal with it together. So
yeah, it's a bit hard to do post-conference drinks, isn't it, across Zoom? So they have to figure that out somehow, and that'll make it the proper conference experience. I mean, Remco, from your point of view, I mean, how many hours a day are you on Zoom calls with potential managers or existing managers? And when you're approaching kind of due diligence of potential investment opportunities, what processes have you got in place which are different than post-COVID-19 or pre-COVID-19?
I actually think it's been a lot more, spending time on Zoom and other programs to talk to managers a lot more than previously. I also think that the productivity and sort of the efficiency of our investment process has only improved throughout this period. I would say that's very obvious, and that's also what Mick is saying, that it's more desk analysis today than it is field research. For us, it remains a very important thing that we need to have met a manager face-to-face historically. At the end of the day, it's a trust business. We send checks of tens of hundreds of millions across the ocean, and we need to make sure that these checks end up with the right people. So what we will do and have done still is perform due diligence on managers that we have met in the past. And luckily, we have sort of 3 members in the team that have been in this industry for sort of better part of 20 years. So we know most of the managers of institutional quality out there. But completely new manager relationships, we will entertain discussions with, but we will not pull the trigger on in this phase. So we need travel to resume before we can really add new managers to the grid. And also, I think that the fact that we've always sort of been running concentrated portfolios has helped. I mean, first and foremost, in a stressful period, the focus is on your existing portfolio. The focus is on getting on the ground data and information about what the managers are doing, what the markets are undergoing that they are active in, and using that as an ingredient, sort of steer your own strategy allocation. But no, we're open for business, but not sort of brand new business, if you will.
So it's fair to say when things return to some sort of normality, or the new normality involves travelling, you still will be doing the on-site visits as for new managers. You will go back to doing that.
Yeah, but I would say that in the old days, we would do perhaps 4 to 6 meetings. And in the new days, maybe 1 or 2 would suffice. And the rest we can do virtual.
Yeah, I think that's it. We're all adapting to virtual work. And in some ways there are some things you cannot do, but yeah, that initial meeting face-to-face, but further in the relationship can be Zoom. I mean, Tom, does that chime in with what you're hearing from your investor members when it comes to finding managers? Are they like Remco, maybe holding off on screening?
Yeah, I think it's fair to say. Yeah, I think so. I think that is fair to say. There are many challenges to onboarding at this time. Both of the guys have mentioned that, but I would also say there's a couple of other things to think about here in our conversations that we have with investors. Even when as we all know, in March there was incredible dislocation in the market, but it very quickly reverted back to the mean, and opportunity to take advantage of the dislocation was very, very narrow in terms of the time being able to do so. So the investors that we spoke to felt that depending on the type of structure they were in, they weren't able to take advantage of that dislocation, and they felt that they were somewhat hampered by that, and it remains to be seen whether they go and revisit their fund structure in the future. Also, when it came to making any decisions around the investment committee level, there was a lag in being able to get agreement across the committee, just because of the period of lockdown that we all encountered, and how it went into lockdown, in terms of it staggered across Europe and into the US and so on. And then when it came to even having trustees at board level or fiduciary, an equivalent responsibility, there was a time lag as well in being able to get any conversation going with them. So these are things that investors wouldn't have thought about, obviously, in the onboarding process, perhaps the due diligence bit, but we're somewhat taken by surprise in in terms of the lag there. And even when it came to thinking about making new decisions, as the guys have mentioned, it is to pre-existing relationships. And I would be slightly concerned about where the industry might be going if we would continue in the status quo, where if you're not able to carry on due diligence in the way that we're all accustomed to doing before this lockdown, is that going to lead to a bifurcation in terms of how an even more extreme bifurcation of the industry, where the money goes to the established players? So, we are obviously keeping an eye on that, and investors are having to do what they think is right by them. They're not going to have that they're not going to be able to sign off on something without having that full operational due diligence experience, which requires things to be done on site and having in-person meetings.
A question has come in from the audience regarding security and security concerns with how you communicate with your investors. I mean, has that changed? Have you seen any specific questions about that, Tom, from your members? We all get told about Zoom security kind of here at Preqin very often, so I expect to see.
Yeah, well, of course, and it's having that bilateral arrangement between manager and investor as to what is the best medium to speak on, communicate. We've seen as well, and indeed they have existed before this period. We've seen the existence of new portals, virtual capital raising platforms that have emerged. And I think you will see more of them, obviously, as long as the status quo continues. But security, of course, is a big issue, even when it comes to, signing off on contracts. How does one go about doing that? Will they accept an electronic signature? I'm not sure. Maybe it's one to ask the guys. But these are questions that we have been hearing and trying to address.
You're doing my job for me, Tom. Mick, have you had any thoughts on this topic? And maybe Remco, if you have some, can chime in as well.
I actually think that sort of business continuity planning has always been a focus of the industry, and it might be sort of a fading focus right now, because I think that we've seen that the industry can live through a crisis like this. I think cybersecurity and cybersecurity attacks, they have gone up sort of 2 or 3-fold over the last couple of months. So that is a genuine concern. And to be honest, I am doing this Zoom video on my private laptop because my company doesn't allow me to go on Zoom. So wow. I do think that that is definitely a point of interest for the industry. Yeah,
probably one you're having to help tackle, Tom, I would imagine as well.
And I suppose what we've seen it a little bit has been at the client side, where some clients are prohibited from using certain platforms, so therefore you've got to give the solutions that work for them. That's probably the main thing. And I would agree with Remco, is that certainly, when we all move to remote working, it does create risk around the cyber piece, which obviously, requires robustness in how you approach it. But I suppose these are challenges we've all faced very quickly, and for many firms have been thrown into this, where, the full team are effectively now remote. What we see is at the manager levels, it's often the case that, certain people within a team or a group would be naturally, more flexible in terms of working, but the whole team then creates a different dynamic. And that element of cross-checking, working with each other, that's something we all need to check in on, and how the culture is evolving as well. I think that's an important piece.
I think it is. Everyone's having to learn on their feet very, very quickly and change. And I imagine there's a lot of new businesses kind of springing up to help tackle some of these issues out of it as well. So there's always opportunities. Talking of opportunities, we'll be moving on to a topic of opportunities from the crisis. And before my next question, there's another question for you guys in the audience. What strategy do you think will provide the best opportunities for the rest of 2020? And please select the one that you'll feel most confident on, and we will come back to those results after I pose another audience question to everybody, actually, which is, from Sam's presentation, it showed that US hedge funds have navigated the crisis better than European counterparts in terms of performance. Why do you think this might be? And actually, is that your own experience in terms of your US versus European funds? Remco, maybe I could start with you.
I would say that that's also our experience. Yes, I think I mean U.S. markets have taken leadership in the recovery and the rebound. I think the Federal Reserve has also been the most aggressive central bank out there. The fiscal stimulus from the government has been overwhelming. So I definitely think markets are on steroids, and that's has sort of propelled U.S. managers to come out of this crisis perhaps stronger than their European and Asian counterparts. Yeah, for sure.
Mick, have you got any thoughts on that topic at all? You're on mute.
Not as relevant in terms of the CTA piece, because obviously we're all trading the same market. Yeah. But obviously, as Remco says, the response was much more dynamic out of the US, which again, given the CTA's focus on global markets, you know, that's sort of, it naturally falls out that they will be participating. I think in different strategies, obviously the responses can be slightly different, but we certainly all watch the US with you know, huge daily interest, as I'm sure everybody in this session does.
Mm. Okay, let's move on to strategies where you guys are investing. Before you talk about you know, what changes you'll be making for the rest of 2020, perhaps let's have a look at the poll results to see what the audience is thinking at this time. Credit strategies, well, Sam did say it earlier, so credit strategies are coming out as number one. Sorry, Mick, CTA is just 6% there, but we can talk about that in the session. So perhaps given it's looking good for credit, Remco, can start with you. You know, what's your plans at the moment, given where we are for the rest of 2020?
Oh, sure. I mean, we've always had a particular sort of expertise in credit, so this environment is very well suited to our skill set. We've been waiting for this, to be honest. We had low allocations to credit distressed and structured credit going into 2020, and we will definitely take them up. Structured credit was obviously a very large sort of technical dislocation in March, and since then we've seen quite a bit of a rebound. The distressed sort of playbook is really live. I mean, we've seen the filing of Wirecard today. We've had sort of companies like Hertz file for bankruptcy. We've seen sort of more than 70 billion of bankruptcies already in the US, and I reckon that post summer that number will be a lot larger. So I definitely think there's an opportunity there, and what's also been helpful is that the managers in this space have been sort of truly agile. They haven't been sort of buying up the companies that were already sort of facing distress prior to COVID, but they've been participating in magnificent size in new issue sort of investment grade in the US, where bonds of Coca-Cola, Wells Fargo, Goldman Sachs were offered at sort of 400 basis point spreads with very long duration. And those were no-brainers to make tens of points of returns on. So I think they've been really sort of agile, not being sort of myopic, looking at the companies that are already in bankruptcy, but looking at the entire sort of swath of opportunities in distress. And over summertime, and as the defaults will trickle in, I think their focus will move towards the real restructurings. And as we've sort of seen in history, those tend to be very sort of fertile periods for distressed managers to generate performance.
Yeah, it seems to bear out where we're seeing the appetite more broadly from LPs, both in our wider data set and on the poll today. I mean, Mick, what's your plans for the rest of the year? Any types of CTAs, managed futures, or macro strategies?
Yeah, well, I suppose compared to your questionnaire there, obviously we're in one segment of that, one strategy, and yeah. And I suppose how we think about that is that as a multi-manager, we combine lots of different strategies within that. So we see managed future CTAs as a more broader, diversified strategy, and you know, as you've seen in Sam's presentation, CTAs delivered very well in Q1, and actually, in Q1, the big differentiator was actually the role played by shorter term managers, who genuinely have been out of favor somewhat over recent years. So they did very well, and that's the nature, I suppose, how we see it, that multi-manager, multi-strategy within the CTA space. You know, I listen with great interest to Remco and the credit strategy, but I suppose we're all in a gigantic experiment right now, and we don't really know what the outcome will be, and we've gone from living you know, with great certainty, but to now living with great uncertainty. And I think while I see the CTA pitches at 6%, it might be somewhat counter-cyclical by the end of the year, so you never know. But we are genuinely in a very unusual environment, and we're living it live. And I say to a lot of younger people in Abbey, like, this is your first real crisis you're living through, so it's important to to be aware, to listen to it and to see what it is. So I think we need to be, aware that investors coming back to markets will be more in tune towards diversification where they can get it. I think that's something that we notice will come through strongly out of this environment. And whatever the outcomes are, we'll see.
Yeah, I think it's just a fantastic point. It's such a big experiment. Nobody knows how and when the pandemic will end, and we can compare it to the GFC, the financial impact of the GFC, but we're in a health crisis, not a financial crisis, so we just don't know what the world will look like. I mean, Tom, I saw you nodding along a lot to Mick there. Is he hearing similar things and strategies and preferences from the investor members of AIMA?
Yeah, I think it's as Mick says, the strategies that are truly uncorrelated are long the volatility, because we had the VIX in March at 85 and, I think it's around 30 now, and most commentators would suggest that we're not looking at a V recovery, and it's more like a U-shaped or a W-shaped recovery. So if that being the case, then we're going to have more market disruption. And to the extent that you have a strategy that's long volatility, historically, that suggests you'll do well. I might add that just one counterpoint to what Remco was saying about credit, and it's just for the sake of being contrarian, really. But I've been speaking to a couple of prime brokers in the last few days who have had surveys of their investor clients, albeit, this might be a biased population. But what was striking from that was when asked the question as to which asset class they think is going to do the best coming out of this period, they and I was surprised myself as well, they suggested that hedge funds would do well. In thinking about that, multi-year private credit has done exceptionally well. We all know that. But investors sense that maybe they're being a bit over-allocated to private credit, and that there may be liquidity challenges going into next year. And do they want to have too much of an exposure to private credit is something that they're thinking about. So it might be that there might be a preference to move out of the illiquid private market into maybe more liquid strategies, just to navigate through those liquidity challenges if they arise. Just thought I'd throw that out there, because it is a counter view. I'm surprised myself a little bit by that view, but investors are clearly thinking about this.
Definitely an interesting point. I mean, obviously we track the illiquid private credit market and the liquid private credit market, and Remco more on the liquid side of things. We still see an awful lot of appetite for illiquid private debt, so private credit, but I do think there is a sense that investors have really ramped up their portfolios pretty quickly, and perhaps now it's time to slow that pace down. Remco, I don't know if you have thoughts on that point that Tom made.
Yeah, obviously private credit industry has grown massively in the last couple of years as investors sort of need return, but they might also have been sort of overreaching for return. And I definitely think that a lot of these teams are untested. They haven't gone through a proper cycle before. So these are all first-time funds, first vintage. And I think a lot of those loans are basically free tickets to the bottom. So some of our managers already see sort of rescue financing opportunities to private debt funds, because they basically need fresh capital to keep their companies afloat. So I think this is all sort of interconnected, and that we'll see it playing out over the next couple of years.
Good old hedge funds, always evolving very quickly when they see an opportunity, and that's a good example there.
Things evolve very quickly. So as an example, I mean, we saw fantastic merger arb spreads in March and added to it, and at this point find it the most unattractive strategy. So have recycled out of it already. So things go really fast. And in terms of talking about all types of shapes, this was mostly sort of I-shaped, what we saw in March and a couple of months thereafter.
Yeah, well, it's crazy how things change so quickly, and it sounds like you're having to adapt your portfolios in real time, which is good. It sounds like I'm sure that strategy is working. So moving on to the final part of the panel today, looking in our crystal balls and in the future about where we see the industry moving as a result of the pandemic. The final question for the audience, we'll be showing a poll now, is do you think the COVID-19 pandemic will lead to more consolidation in the hedge fund sector? And we're talking about assets under management here. As Sam showed, we've seen continued outflows from hedge funds over the last few years. Growth has really only been driven by performance, and our performance is negative. Do you think that hedge fund AUM will decrease, increase, or stay about the same as a result? So we will come back to those results in a minute. So whilst you're busy answering that, I'd like to ask Tom how AIMA have been helping their members through the crisis. What are the common requests that you're getting from your members, and how are you seeing the hedge fund sector evolve in real time?
Right. Well, not surprisingly, we've been extremely busy on the compliance and regulatory side of things, certainly through March. You know, I can think about it now in somewhat, you know, lightly, let's say, but there was a genuine concern back in March for capital markets to cease in the way they would normally function, so much so that we wrote to the US Treasury, to the SEC, and to the Federal Reserve, you know, astonishingly requesting them to keep the markets open. But also to, you know, make sure that various actors have access to market clearing and settlement operation sites. Obviously, that never came to pass, but there was a genuine fear at the time. You know, and we also wrote letters rather to regulators in the EU, UK, and APAC as well. Mick has mentioned about the slew of short selling restrictions. You know, we spoke to all 6 representatives across continental Europe about the short selling bans that lasted from March through to May. You know, rather unfortunate as they were, you know, they were put in place. It seems to be a popular lever that policymakers call on when markets go into distress like they did then. You know, thankfully we're at the other side there. And then speaking to members and on behalf of members, you know, working with regulators to help our members be able to meet their reporting obligations in a timely manner. You know, we've had constructive conversations with policymakers globally on that, managed to get a extension to, you know, the uncleared margin rules and the phase 5 and 6 of the initial margin requirements, spoke to ESMA about SFTO reporting requirements, which was at the time having a deadline in April, which has been extended to July. MiFID II as well, reporting was extended from the end of March to the end of June. And you know, so there was a consultation that was going on at the time, which was due for the end of March. And that was subsequently extended by about 4 weeks. So very busy on that front. I think we managed to get concessions, you know, for the industry around the reporting requirements. But apart from that, it was really helping our members understand about what we talked about already, working remotely, taking from, you know, we were able to see from our membership in the Asia Pacific region, which obviously experienced this outbreak before anywhere else in the world, how they were operating, you know, a sense of whether they would be able to navigate the pandemic, taking the lead, you know, from what our members were doing about how they were looking to manage staff and getting them to work remotely, and just being in constant contact with them to understand a little bit more about the situation so that we could knowledge share. And my sense during this period, certainly across our membership, is that it has really become a very strong community in helping each other out. I think everybody, you know, as Mick has said and Remco has said as well, we're all in the same boat here. And it's just to try, and it's, you know, again, people use this a lot, but I think it's never a truer description. It is unprecedented in terms of the emergency that we've gone through. And just trying to help each other and learn from, you know, the steps that we've taken in going through this. You know, AIMA has been trying to act as a medium to help, you know, the industry in doing that.
I can see all the good work you guys are doing at AIMA. I'm a member and I go to a lot of your webinars that you organise to help your members and create that community. So I think it's really fantastic, and having Zoom, I think, as you mentioned earlier, has really enabled us to band together and to share knowledge, and I think that's fantastic stuff. So moving into our crystal ball section, why don't we have a look at the poll results first to see what everybody on the call thinks will happen. Oh, we've got slightly increase and slightly decrease. We have slightly increase winners. We've got quite a bullish audience with us today. I think that this is linked to your point you raised earlier, Tom, that we're seeing more appetite from investors for hedge funds as a result of the crisis. And maybe this can turn things around and see some more asset flows come in. It'd be nice to have a positive flow into hedge funds for once. Every time we put that report out, it's always negative. So perhaps the audience is indicating that might be the case. Mick, I'll start with you. You know, do you agree with this? Do you think that we will see more assets come into hedge funds and into your part of the world? And what do you think the hedge fund sector will look like in a year's time?
Yeah, I mean, I'm always slow to make predictions because, they tend to be wrong. But equally, what I would say and think is that, back to my point that this is a gigantic experiment we didn't see 5 months ago, and now we're in it. And what the amazing thing, I think, as Thomas said, how the response has been. But when I think about, say, hedge funds and, systematic hedge funds and systematic strategies, they are learning systems. And the type of volatility spikes we saw in VIX, but also in other sectors as well, was very unusual. So, the whole daily process we think about in managed futures is the learning of the new data every day and how that feeds into systems, etc. But I would say the uncertainty is the key thing we're all in together. And while we can all predict what's going to happen, there's no doubt about it that there's a big disconnect between what we see in equity markets and what we see in the underlying real markets we all see every day when we leave our homes. So there's the potential for more volatility is there. Timing, who knows? But I think that what I've always found very encouraging is the sort of the ingenuity within the hedge fund sector to respond and to learn, but also to be the first mover, and also to be very strong on the risk management side as well. So I think it's very well positioned. What will investors look for in the future? I can say from our conversations, what we see is people are more uncertain. To some extent, volatility returned very quickly, and now it's sort of gone away again. But there's a lot of uncertainty out there, and there's still a lot of big banana skins out there waiting for the markets. And I think, what we hear from our clients is diversification is important. Liquidity is important, and those things often can be a little bit put to one side when markets are performing very easily. So, but I'd be optimistic. I think I always see it as more learning, more systems, more development, more drill down, some of the tools that we have access to now, and how we've changed. If you think about how it's changed in 10 years, that speed of change, and performing a role as a diversifying strategy within, people will still hold equity and bonds in their portfolios. What else can we do? So no prediction.
You need a bit of optimism, Mick. That's good to hear. I like a bit of optimism. So much pessimism in the news and everywhere else. Remco, what is your sense of it? So you mentioned earlier you're only allocating to managers that you've met on site, and I think Tom made a point, is can we see the dispersion between the emerging managers and the big managers grow even further? Do you think there will be a fallout? Some smaller managers will go out of business? To Sam's earlier slide, we saw more liquidations last year than launches. Do you think that will be exacerbated? What's your sense on the new hedge fund industry post COVID-19?
No, I think so. Yeah, I think making ends meet for smaller managers is difficult, particularly with the higher costs of compliance and sort of regulatory overview. So you really need to have skill to be in this business. But by nature, I'm not a big optimist, but I actually am quite optimistic about the industry right now, and I think we'll see an inflection point. And I think the reason for that is that hedge funds were not part of the problem this time around. 2020, we're sort of halfway into it. This is not such a bad year. I mean, compared to 2008, 2011, even compared to 2018, it's not such a bad year. The hedge funds have done reasonably well. They have proven their utility function in the portfolio, and there are sort of green shoots here and there. So I'm quite optimistic about that, particularly in the context of broader markets. I mean, in government bonds around the world, there's no yield anymore. If the Fed and the ECB keep continuing investment grade corporate bonds, there will be no yield left either. And investors need returns. I do think that those returns are available in the hedge fund space. And I think there maybe a couple of things need to change for that to happen. So I still think that the fees that investors have to pay for their sort of their hedge fund relationships are too high, and that's keeping institutional investors away from the asset class. And I also think that we need to embrace ESG much more actively. And I think if we can get those 2 points across, lower fees and ESG integration into the hedge fund universe, then I think we're off to a multi-year growth period.
Remco, we got all the way nearly to the end without mentioning fees. I'm disappointed in you. We all mention fees on a panel. No, it's good. It's a very good point, and it's a point that we hear a lot. Fees have been talked about for the last 12 years, post-crisis, post-GFC, and still fund managers are far too high. So I think that will change. And it also helped me because one of the audience questions that come through is around ESG, and we see this at Preqin as being really important across all alternatives, but increasingly in hedge funds. And Tom, maybe you can take this one, which is, and I know you guys do a lot of work on ESG, is will the importance of ESG-oriented funds gain more importance in the US? It's popular in Europe, but not the same and valid in the US. What's your opinion?
Yeah, I mean, this is a separate call we can have on this alone. So I will try to make my comments very brief. The drive and the momentum for ESG is being led on the policy side primarily with what's going on in Europe with the EU Sustainable Finance Action Plan. And that's a game changer in that it will have asset managers and asset owners have to disclose what they do regards to their risk management and their investment approach and how they will go about using ESG in that. And that change starts in March next year. Leading with the Scandic region, and then to a certain extent, your Superan funds in Australia, and then what's happening then in other small pockets of the world, ESG has been driven primarily by there. The US is lagging a little bit behind Europe, and then APAC lagging again still. But there is a drive, and I think it'll be accelerated in light of this pandemic. You're seeing the social element being played out in the press and in the news on a daily basis. You're seeing the consideration for, when you think about the vaccine, and the interest in biotechnology is only likely to heighten as well. So I think that need to help one another, is going to, really advance over the next couple of years. There is already a big momentum behind ESG. I think this will push it further still. But there are challenges to implementing ESG that the industry needs to meet before it can truly be able to deliver on a product that is able to outperform, have that double bottom line proposition in terms of being able to perform as well as do good.
So largely 3 positive messages from all of you right at the end. So it looks like we do expect ESG to be more embraced, and that's actually accelerating. That is actually all we have time for today. Firstly, I'd like to thank Tom, Mick and Remco for joining the session and providing such great insights. A big thank you to you, Sam, for the excellent presentation at the start of the session. And finally, a thank you to everybody on the call today and your continued support of Preqin and our data. Before we log off, a final housekeeping note from me. You should all receive an email later today with information on how to download these slides and also with a recording of the webinar. If you do not receive this email or have any further questions, then please contact our events team, and you can see the email address here. With that, thank you for your time, and I hope to see you all on a future Preqin webinar, who knows, maybe one day in person. Thank you.